Good morning, classmates. So I'll be discussing, let me share my screen. I'll be discussing establishing the dividend policy. And this will be my topics. First, we're going to define what is dividend policy and identify the key components of dividend policies. Third is to identify the importance of dividend policy in corporate finance. Fourth is the factors influencing dividend policies and the dividend policy models, and of course, the challenges and considerations in dividend policy, and lastly is the conclusion. To start with, let's define what is a dividend policy. Okay, so dividend policy refers to the strategic framework or guidelines adopted by a company for distributing profits to its shareholders. Also, it involves decisions regarding the amount, frequency, and form of dividends to be paid out to shareholders. Okay, so that's the definition of dividend policy. And the following are the key components of dividend policy. So we have five components. It's the dividend amount, dividend frequency, dividend form, and retention ratio. Okay, so for dividend amount, it determines the portion of profits distributed to shareholders. While dividend frequency, it determines how often dividends are being paid. It could be quarterly or annually. Next is the dividend form. It specifies whether dividends are paid in cash, in stocks, or any other forms. And retention ratio, it indicates the portion of profits retained by the company for reinvestment in business operations. Okay. So let's proceed with the importance of dividend policy in corporate finance. First is it signals companies' financial health and performance to investors. Second is it influences investors' perception and stocks valuation. It plays a role in attracting and retaining investors. And lastly, it impacts companies' cost of capital and structure decision. So that's the importance of dividend policy in every corporate finance. And the factors influencing dividend policies is first is financial performance, wherein the profitability and cash flow stability influence the ability to sustain dividend payments. And for companies with consistent earnings, they are more likely to adopt stable dividend policies. Second factors that influence dividend policies, market conditions. The economic cycles, the interest rates, the market volatility affect dividend decisions. And some companies may adjust dividend policies in response to changes in market conditions to maintain financial stability. So the third factor is legal and regulatory environment, tax laws, corporate governance regulations, and accounting standards. This impacts dividend policy decision. And compliance with legal requirements and regulations guides dividend distribution practices. Another factor is the shareholder preferences. So investors' preferences for income versus the capital appreciation influence the dividend policies. Companies may consider shareholder demographics and preferences when determining dividend payouts. Lastly, the growth opportunities. Okay, so some companies with growth opportunities may choose to retain earnings for reinvestment in business expansion. And dividend policies may vary depending on the stage of the company's life cycle and its growth prospect. Okay. So next topic is the dividend policy models. I was able to identify five models or theories with regards to dividend policy. First is Walter's model. It was proposed by James E. Walter in 1956. This model states that the dividend policy decision affects the value of the firm. So dividend payout is determined by the relationship between the internal rate of return or the IRR and the cost of capital. Next model is Gordon's model. It was introduced by Myron J. Gordon in 1959 and based on the Gordon growth model, also known as the dividend discount model. It suggests that the value of a stock is directly related to its future dividends, discounted at the required rate of returns minus the growth rate of dividends. Third model is Lintner's model. It was developed by John Lintner in 1956. It emphasizes the importance of stability in dividends. Some companies may tend to set standards, set dividends based on long-term earnings expectations rather than short-term fluctuations. The fourth model or theory is bird in hand theory. This was proposed by Myron J. Gordon and John Lintner in 1963, which stated that the investors prefer dividends in hand to uncertain future capital gains. So dividend policy is influenced by investors' risk perception and preferences for current income. Last is the dividend irrelevance theory. It was proposed by Franco Modigliani and Merton Miller in 1961. So it argues that dividend policies has no effect on stock price or firm value under certain assumptions. For example, the perfect capital markets, no taxes, no transaction costs. And in this model or theory, investors are indifferent between receiving dividends and capital gains as they can create their desired cash flows by selling shares if needed. Okay, so the next topic is the challenges and considerations in dividend policy, in establishing dividend policy. First is the tax implementation, which dividends payouts may have tax implications for both companies and shareholders. So companies must consider tax-efficient dividend strategies to maximize shareholder returns while complying with tax regulation. Another challenge is capital structure. Dividend policy decisions should be integrated with capital structure, considering to maintain an optimal balance between debt and equity financing. Balancing dividend payouts with investment needs and debt obligation is essential for financial stability. Okay. Next is dividend smoothing. Smooth dividend policies aims to maintain a stable dividend payouts over time, smoothing fluctuation in earnings and dividends. Dividend smoothing implements strategies that require careful management of earnings, earnings volatility and capital allocations decision. Okay, last challenges that need to consider is dividend reinvestment plans or DRIPs. Companies offering DRIPs must consider administrative tools, dilution effects, and shareholder preferences. And designing and managing DRIPs effectively can actually enhance shareholder participation and long-term investment. For the conclusion, um, The dividend policy of the future is expected to undergo significant changes because there are some factors that we need to consider like sustainability, adaptability, integration of technology, customization to investors' preferences, and emphasis on total shareholders' return, integration of ESG and CSR, increased shareholder participation, and legal and tax implication. So prioritizing these factors will actually maximize shareholders' value and promote long-term success in ever-changing corporate and financial landscape if you are going to adopt these changes. Thank you. That will go. Thank you.